All right, so welcome back to this video series where we'll be talking about how do we invest as a beginner. Okay, so for some of you who are joining this for the first time, just to let you know, my name is Derek. I've been investing for about 10 years. I hit my first million by the age of 32, and I've been coaching investors from many parts of the world how to invest and how to build their portfolio over the past 8 years. Okay, now if you're coming to this video from part one, obviously, if you do not know what is part one, then never mind. I will put the video link in the description below. Okay. So if you're coming from part one, most likely you have taken care of the basics, meaning that you have your emergency funds taken care of, your budget, your savings is all positive, and you are well insured. So your foundation is ready, and okay, I want to start investing, I want to start growing my money, and how do I do it? So it goes without saying, if you want to start investing, the first thing that you need, for stocks at least, you need to have a brokerage account. Now, I use Interactive Brokers and I use Momo. Okay, Interactive Brokers is where I put most of my money in. Okay, and Momo is based in Malaysia, which I put some of my money in. Okay, yeah. Now, I will not be going into so much detail about why I like these platforms or why I select them or how to use them. I'm sure many content creators out there have done videos on it. What I would do instead is I will include the links to these brokerages in the video description below as well, so you can access it. But if you want to know how to use these platforms or why they are good, I mean, there are so many, right? There's Tiger Broker, Webull, so many. If you want to know which is the best for you, feel free to do a little bit of research, go through other content creators' channel. Now, this video we'll be talking about what do we invest first, because your brokerage account is ready. You'll be asking, so what do I buy first? What stock to buy? Okay, so that's what we're here to discuss. Now, before we even talk about what stock to buy, I need to set the mindset right. Okay, I need to set the whole idea about investing right, and I do that by showing you this one picture. You see, when we invest, right, we got a very simple rule. We want to make money. Everybody invests one purpose only, is to make money. If you're not making money, there's no reason why you should be investing. Okay, so how do we make sure that we have the highest possible chance to make money? That should be the question, right? And I want to show you this chart, okay, this statistic that what they did was they took the returns of the S&P 500, which is the top 500 companies in the United States between 1926 to 2019. Okay, so that's almost like 100 years, I think. Yeah. So they took this period of time, right, and they compared the returns based on your time period that you're focused on. So as you can see here, if during this period of time, if your investment is always focused on 1 month, 62% of the times you'll make money, 38% of the times you lose money. Okay, if your focus during this time period is always 1 year, 1 year time focus, you'll realize that 75% of the times you make money, 25% of the time you will lose money. Okay, and then you notice something as the years get longer and longer, like up to 15 years, right? Okay, up to 50, if you're investing for a 15-year period, you'll realize that 99.8% of the time you will make money, 0.2% of the time you will lose money. Now, what is the main lesson here? If the whole idea of investing is to make money, right? What is the number one lesson that we can draw from this statistic? And that's very simple. The lesson is to always focus on the long term. Now, I have been investing for about 10 years. I can tell you this is very, very real. Okay, when I first started investing, I'm always focused on the short term. Okay, so what could possibly make the share price go up 20%, 30% in the next 1 year, next 1 month or so? And I realized that by focusing a lot on the short term, my stats was worse than that. By focusing a lot on the short term, I've lost a lot of money. And only by focusing on the long term, passively investing, right? That's where the wealth start to grow. That's basically one of the reasons why I hit the first million in the first place. Now, focus on the long term. So the thing is, a lot of investors, when they first started, they'll ask what stock to buy, when to buy. They'll start to learn technical analysis, they'll start to learn fundamental analysis, whatever you want to use, economic indicator, so many different techniques. But I've worked with so many investors across 8 years. I can tell you, when a lot of people, they start investing, right? They call themselves investors, but I tell you, they are just betting. So how do I know they are betting? Just look at the results. Some years, they make a whole lot of money. And some years, they give back. People always say, I make all this money, the next year, give it all back to the market. So they make money, they lose money. Make money, lose money. So if you see their returns over the past 5 years or so, they have been investing, it is like net zero or negative. Very little returns. So that's how I know they're betting. Another reason, to know if someone is betting or not, you see how they invest. If they invest, right, they say things like, okay, I think this oil and gas stock is going to do well. Okay, they found a new oil well, or they have a new contract, whatever it is, and they start to put in a lot of money there to capitalize on this opportunity. That to me is like betting already. Okay, that to me is like betting. Okay, it doesn't matter whatever is oil and gas or whatever company. Some people will say, hey, this company got this contract from the government. Okay, so they're going to achieve this amount of revenue, whatever. So they put money here, try to take advantage of it. That to me is betting. So we or myself, I don't focus on betting. I don't do that. Okay. Instead, I focus on building. So what is the difference between betting and building? Building is basically the one key difference is accumulation, collecting. Okay. Got savings. In other words, every month I have a bunch of savings, use it to collect, buy more, accumulate more, build the portfolio over time. Okay. I don't bet on events. I don't bet on events. I build the portfolio over time. Later on throughout this presentation, you will see, okay, how it's done. And you'll realize one thing also about investing as you stay in this game longer, right? The game of investing is the game of self-control. If you're able to control your emotions very well, you will do very, very well in investing. Okay, and this is a personal experience that I want to share with you. You will not realize, I'll let you know, you will not realize emotion creeping in. Emotion will just, as you're doing your stuff, right, deciding what to buy, what to sell, emotions will come in and they will influence your decision making. I call this being tilted, 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 which means that, hey, let's say, oh, you lost money on a stock, right? Then you get so emotionally involved that you make a series of wrong decisions. Okay, I've seen some investors, they lost 30% of stock price drop, right? So they lost 30%, they want to make back from the stock. So they, in other words, they want the revenge trade. So they start to buy up more and more. They say, last time is high, now 30% cheaper, I can buy more, average down, right? So they buy more and more, and then end up the company go down, become even worse. They lost even more money, right? So we want to get emotion totally out of the equation. We want to focus on data. We want to focus on facts. And in order to make sure that emotions stay out of the way, right, we follow a portfolio framework. Okay, we follow a portfolio framework, and that's what I do today. I follow a portfolio framework very, very strictly. Okay, now the framework that I use, I call it the BIA portfolio framework. It is built upon, about 10 years plus of the investing experience that we have. Okay, and it's condensed into a set of rules, which we now call the BIA portfolio framework. Now, there are a bunch of rules, of course, but today I think we're going to share only the first rule, which is, you'll see here, ETF equals to the core, stocks equals to the booster. Now, investing for the first time, right? What on earth is an ETF? What is a core? What's a booster? Okay, so we'll cover in more detail, but we want to talk about the ETF first. And in order for me to explain this easier, I will use an illustration like this. Now, if you see this picture is a picture of a cake, right? Now, if you slice the cake, there's, the cross section there. You'll notice in the middle, there's this red color stuff here. That's the sponge. Now, what's the purpose of the sponge? People who make nice cakes, right? They always have the sponge. So why have the sponge? It is to give the cake structure. Because if there is no sponge, the whole cake will collapse. Agreed? Yeah, you can't just make cake from cream, right? Yeah, you need the sponge to give it structure, give it a shape. So without the sponge, the whole cake will collapse. And that is what the ETF is. That's what the ETF is. The ETF serves as the structure of the portfolio. And then when I add individual stocks, whatever stocks I add, Apple, CrowdStrike, whatever the companies I add, they are all the decoration or the booster. It makes the whole cake much more pretty, much more beautiful. Okay, so that's the purpose of other stocks that I add to the portfolio. But the main one is always the ETF. That is the core. Okay, so what is an ETF? Wow, it's so important, but what is it? ETF stands for exchange traded funds. So to answer the question, what would I buy first? If I start investing all over again, okay, and I have a bunch of money right now, what would I buy first? I will first pick out my exchange traded fund. So what is an exchange traded fund? Think about it this way. There are two ways to invest. The first way is to pick your own stocks. So you can go out there and decide, okay, I want to buy Google, I want to buy Amazon, I want to buy Facebook, I want to buy whatever stocks you have. Okay. And then when you manage your stocks, your portfolio yourself, you need to decide, first thing, of course, what stocks to buy. Second thing you need to decide is, okay, so how much should I buy? How many percentage to this stock? Okay, and you need to decide, should I buy more? Should I sell? Now, should I add? Should I reduce? Okay, there's a lot of decisions to make when you're building your own portfolio. Now, an ETF, basically, you're not buying an individual stock. An ETF, you're buying a basket of stocks, a basket of many different companies. It can range from 20, 30 shares to thousands of shares. Okay, so think about it in simpler way. An ETF is basically a basket of stocks, and you can buy the whole basket of stock for a single price. Now, the benefits of an ETF, the first one, of course, low cost portfolio management, very cheap. Instead of buying many different stocks at individual prices, Apple 200, Amazon 200, buying so many stocks at individual prices, you can buy all of it for the price of one. So it's a low cost portfolio management strategy. Number two, it is also a passive portfolio management strategy. Very passive because no longer do you need to make a decision about what stock to buy, what stock to add, what stock to reduce, how many percent of portfolio. You don't have to think about all of this. All of these are done by the portfolio manager. And the portfolio manager has a set of rules that they follow. So passive, very passive portfolio management strategy. And number three, this is what I always tell myself. If I start all over again and I pick an ETF, it is a way for me to learn while I earn. Okay, to learn while I earn. So what does it mean? Imagine you're starting to invest for the first time. You obviously will know nothing. You don't know anything. You for example, buy Apple. Why is Apple so good? Buy Google. Why Google so good? You do not know about the fundamentals. You don't know how to read annual reports. Let's say you want to even use technical. You first time learning technical analysis, so many charts, which one to pick, right? You're going to make a lot of mistakes when you start from the beginning. So the thing is, while you are learning, okay, while you're learning, the ETF grows, right? That's where I will put my money in, and the money will grow with the ETF itself. Okay, so while I'm learning, I don't have to put my money at risk, but the money, okay, is still growing in the ETF. Okay, yeah. So the reason why I say this is also because different people has different learning speed. They learn at different speed. Some people, they learn very fast. Some people, they take a long time to learn. Okay, so imagine you take 5 years, not 5 years, sorry. Let's say you take 1 whole year just to learn how to read an income statement, or you take 1 whole year just to learn how to read an investment report. Okay, and you're not there to buy stocks, right? Okay, I'm very scared to buy because I don't know anything yet. So you take 1 whole year to learn. Now, if the money is in an ETF, for example, let me show you. Okay, like the ETF, let's say I pick triple Q. If your money is in an ETF, while you're learning, the ETF would have grown by 18%. So you're not missing out by taking your time to learn. Okay, yeah. So learn while you earn. Now, the downsides of an ETF, what is not so good about it? Number one is limited control. You have no control. If you don't like Apple, you don't like Google, you don't like whatever stock in the ETF, you cannot tell the manager, you cannot call up, hey, can you remove Google from the portfolio? It doesn't work. Okay, you buy whatever is there. If you don't like, you change your ETFs. Second downside about ETF is very boring. Now, the reason why I say this is because emotion will always get in the way of your investment decision. It will always get in the way. You can tell yourself 101 times, don't worry, I will get emotions out of the decision making. Even after 10 years of investing, I can tell you, emotion one way or another still chatters in my head, and it still, in a way, influence a little bit in the decision making, right? So ETF being very boring, it always, I realize at least, when it's so boring, right, I realize a lot of people, they cannot take it. They start to do something else to make it exciting. The moment your investments get too exciting, I can tell you, you just get ready for massive losses. Just get ready. Okay, it may or may not happen, but if it happens, then you know why. Okay. Yeah. So cons of an ETF is very boring. A lot of people don't like it. Yeah. So these are some examples of the most popular ETFs. One of them is one of the most popular is the S&P 500. Okay. S&P 500 represents the top 500 companies in the US. And you can purchase the S&P 500 through some of these stock tickers, such as SPY, SPLG, CSPX, VO, etc. Now, when you buy the S&P 500, look at what you're buying. You pay one price and you're buying 503 different companies. Okay, 503 different companies, and some of the companies are Microsoft, Nvidia, Amazon, Google, some of the famous brand names. Now, another ETF which is popular is the triple Q, or it's also the triple QM. These are stock tickers, they are the same stuff. Now, this one represents the top 100 company on the NASDAQ exchange, top 100 company. So if you pay $50 for the triple QM, for example, then you'll be buying 102 different companies. And these are some of the companies in the portfolio. Okay, yeah, so you see some famous brand names as usual: Tesla, Google, Costco, Apple, etc. This is ACWI, another popular one. All right, ACWI represents the global ETF. It represents stocks around the world. And for a single price, when you buy this ETF, you're buying 2,351 companies. And these are some of its names. Okay, so this is the global ETF. And lastly, this is the SOXX. Now, ETF don't just have to represent a country, it can also represent an industry. So SOXX represents the semiconductor industry. So some people will say, I believe in the semiconductor industry. Why? Because I don't see a future without semiconductor. It's just going to get more and more important. Valid. If you want to invest in a semiconductor industry, then SOXX is the ETF that represents it. So when you buy SOXX, you're buying 31 different companies, and these are some of its brand names. Okay, so now here's the thing. A lot of people, they say ETFs are boring. One reason why it is boring is also because the returns are so slow. You know, some people who bought NVIDIA this year, 2024, right? They bought NVIDIA, they made about 3 to 4 times their money. 3 to 400%. Wow, that's good. But you cannot expect such returns from an ETF. Doesn't happen. Very, very rare. In fact, I've never seen an ETF 3 to 400%, unless it's a funny ETF. But anyways, most ETFs, right, don't give that kind of return. So people say it's very boring. 8-9% per year. It's so boring, right? I'd rather pick individual stocks. Sometimes people say I'd rather buy crypto. But let me show you the performance over the years. Now, ACWI, if you take a look at this chart, ACWI over the past 10 years, the average return per year is 8.55%. What does this mean? This means that some years from today and past 10 years, some years positive return, some years negative return. So positive, negative. But when you average out, every year average is 8.55%. That's not bad, right? Yeah. SPLG, which is the S&P 500, every year the returns on average is about 12.77%. That's the SPLG or S&P 500. The triple Q, NASDAQ 100, right? Over the past 10 years, the average return per year is 18%. That's even better. Then you look at the SOXX. Over the past 10 years, average return is 25.37%. Now, this is not 3 to 400% like NVIDIA has gone up this year. That's true. But consider this. First and foremost, okay, NVIDIA went up 300% this year. How many percent of your portfolio did you allocate to NVIDIA? If your portfolio is $10,000 and you allocate, $500 to NVIDIA, then even though NVIDIA grows by 300%, you probably gain about 10% in your portfolio. Is that correct? You probably gain about 10%. That's number one. Second one is, can you repeat such returns? Now, I've made my fair share of multi-baggers. Multi-baggers meaning you make more than 100% in the stock. Okay, like CrowdStrike made me 300%. Fantastic. But the question I always have is, are you able to consistently repeat that return? Can you consistently repeat it? If you cannot consistently repeat it, then it's a one-time return. It's not your annual return. Okay, so for SOXX, the average annual return is 25%. That to me is fantastic. Very, very few funds can even perform like this. Very, very few. Okay, so that is why ETF, I put it as a core of the portfolio. Okay, number one, due to diversification, because it has many shares, right? You're buying a basket of stocks. Number two, it has a very strong track record to back it up. Okay, although I must also mention that historical track record is not indicative of future returns, but having a 10-year track record, again, is no coincidence. Right? Yeah. So right now, to answer the question, what should I buy if I start investing first? It's an ETF. I would choose an ETF. Okay. Yeah. If I start investing all over again, I wouldn't even think about what stock to buy. I would think about what is the ETF I should select. And these are some things to consider. Number one, if you're going to select your ETF, I will select less than 2. I won't select more than 2 ETF. Why? Because it is already a diversified product. If I buy 10 different ETF, most likely I'm going to have the same stock in some of these ETF. Number two, I am over diversifying. I'm buying too many things. Okay, so when you buy too many things, your returns may be impacted. So I want to reduce it. For me, even myself right now, I only have one ETF, and that to me is good enough. Okay. Number two, the investment time horizon. Okay, are you retiring soon or are you still early in your wealth building career? Like if let's say I'm retiring soon, okay, if let's say I'm going to retire in the next 5 years, then I would likely select an ETF with lower volatility. So how do I select an ETF with lower volatility? I will select an ETF with more stocks in the portfolio. There's more stocks. Okay, so example, S&P 500 companies, ACWI like 2,000 over companies. Okay, so more stocks, less volatility, right? Number two, if let's say I'm very early in my wealth building journey, let's say I just came out from university, I just started my new job and I want to start building my wealth. So I can take volatility because I have time. So I can absorb volatility. I can wait for the market to recover. Therefore, I would target ETFs that are growing faster, such as the triple Q or the SOXX. These are some examples that I would choose. Okay. Now, lastly, last question is, okay, so I know what to buy. The next thing is to ask myself, how would I buy them? In other words, the acquisition strategy. Would I buy this ETF? Should I buy a little bit, over time, or should I lump sum? If I have 10,000, should I put it all at once, or should I sell? Should I buy like 1,000, 1,000? How should I do it? What I do even until today is I practice something called dollar cost averaging, DCA, dollar cost averaging. And that simply means to invest a certain amount of money regularly. So for example, every month, just an example for easy calculation, every month I save 1,000. Okay, let's say every month I save $1,000. And then with this $1,000, I will use it to buy the ETF. Let's say I selected the S&P 500 or I selected triple Q. Okay, so every month I use this 1,000, I just buy some, collect as much as I can. Now, I can tell you something, I won't mind myself, I won't mind if even 100% of my portfolio, right, is in an ETF. I don't mind. If let's say my portfolio, there's only one stock and that is the ETF, I won't mind. Okay, the reason why it is because it is already a diversified product. You may think it's only one stock, so you're concentrated. No, because that one stock represents 1, 200, 300, 500 different companies. So it's already diversified. Okay, so I always use dollar cost averaging. Now, some people, I can let you know, 8 years I work with investors, right? You tell them to dollar cost average, buy at any price. Okay, at a certain, people will say, wow, invest a certain amount regularly. It means you buy at any price. I do that, yes. Okay. Now, a lot of people, they cannot do that. The reason is because, hey, the price already so high. What if you buy and then the price just falls? There's always this number one concern. People don't like it. It goes against human nature. Now, I can share with you something. It is just difficult to execute. Okay, it is not, to me so far, it's not. The reason why I know it's not a bad decision for me is because I've been making a lot of money from it. But, it's just difficult to execute. It goes against human nature, as I said. Let me show you this chart. If you look at the S&P 500, since 1928 until 2023, there are some ups, there's some downs, correct? Yes, some years you make money, some years you lose money, correct? Now, the thing is, most of it positive or most of it negative. You see that majority or most of the time, it is a positive return. Okay, it's a positive return. So most of the time when I dollar cost average, let's say every month I buy, right? There's a very high chance at the end of the day, I'm going to make money. Okay, now the thing about dollar cost averaging, let's say every month, as I mentioned just now, I invest $1,000. So some months or some years, sorry, the price will be high, so I buy lesser. But some years the price will be very low because it drops a lot, right? That's where $1,000 I can buy even more shares. So the reason why it's called dollar cost averaging is because it will average out. Some years because price very high, you buy less shares. Some years because the price drops a lot, you can buy more shares. So it average out. Okay. Yeah. So dollar cost averaging is a strategy that's been used for a very, very long time. There's a lot of research behind it, and you can go and check those out. Okay. So that's everything that I'm going to share in this short video alone. The next video will be going a little bit more in depth about ETF. Okay. In case some of you want to know, all right, how do I select, how do I do a little bit more research into an ETF? Like how do I pick? Today I only share 4, right? SOXX, S&P 500, triple Q, and ACWI. What about other ETF? Like let's say I want to invest in China, I want to invest in German, Europe, for example, or I want to invest in Southeast Asia, how do I pick, how do I research for some ETF? That we will revisit in the next video. Okay, so if you find this video helpful, please consider following and subscribing to our channel. We look forward to share more with you very soon. So that's all for now. Bye.